Hi everyone and welcome to the recording of the first chapter. Now this is a very exciting chapter and it introduces risk management. So the topic that we are going to discuss in this recording is an introduction to risk management. So we are going to talk about different type of risk, how you should approach risk management and why risk management is important. So let's start with it. So first of all, what is risk? So risk is a possibility that an event, whatever event you are observing, will have an outcome different from the outcome that is expected to occur. So example, so let's say you expect that the stock market in 2023 should increase by 10% in the given year, right? And if it doesn't increase by 10%, then there is risk. So the expectation of stock market is 10% returns. If the returns are above or below, then there is risk. So it is important to understand that risk is both, like having an outcome that is positive or having an outcome that is negative in case of investments. Then the risk could be that you will find a job upon graduation. That could be your expectation, but the outcome could be different. Maybe you go into entrepreneurship, or maybe you move abroad and travel for a few years. So the expectation is different, the outcome is different. The When that happens, there is risk. Risk deals with unexpected outcomes. Okay, so what are different concepts that you should be aware of? There is good risk, that is desirable risk. Example, if your expectation was that the stock market gives 10% return and the returns are above 10%, then that is a good risk because the returns were higher. Or there is a bad risk that the outcome is less than 10%. Okay, there are skewed outcomes. Skewed outcomes means that outcomes are in the extreme. Okay, so like the probabilities are in the extreme rather than outcomes, the probabilities are in the extreme. So instead of having a normal curve of stock returns, that is possibility of positive as well as negative outcome is the same, right? You could have a case where possibility of negative outcome is more than positive, that is a negative skew, or the possibility of positive return is more than negative, that is positive skew. So that is also something that you should be aware of. Sometimes there are no bad outcomes, just positive outcomes, or no outcomes at all. So neutral or positive, that's the only direction, right, you could go. So like example, like let's say you're planning to go for a movie. Two things can happen. You can either go for a movie or you would not be able to go for the movie. But not going for the movie, right, is not a bad outcome. That doesn't harm you. That is not negative in any case. Usually, our interest is in situation with at least one undesirable outcome, that is, there should be a possibility of loss. So this entire financial risk management course is designed towards the possibility of loss. There is another definition. So risk is the exposure to an event in which the outcomes are uncertain and at least one of the outcome is undesirable. So this is a better definition of risk than the statistical one. Statistical one is deviations from expectation. That's the statistical definition of risk. This is a better one because this means that the outcomes should at least have one undesirable state. So once again, I'll read it. Risk is the exposure to an event in which the outcomes are uncertain and at least one of the outcome is undesirable. So there are uncertain outcomes, right, in which no risk exists if the outcome is known, and likelihood of occurrence of undesirable outcomes is higher or lower. So I'll explain it a bit more. What are uncertain outcomes? Uncertain outcomes means difference from expectation. Now, sometimes, right, there is a risk, there is no risk exist if the outcome is unknown. So there is no negative possibility, right, that can happen. Example, going for the movie example. If you don't go for a movie, that is not a negative outcome. So there is no risk that exists, right? Also, likelihood of occurrence of undesirable outcomes could be higher or lower. Now, exposure to an event, some exposures can be avoided. So if you are worried about risk and you want to plan your exposure to certain events, some exposures can be avoided. For example, if you are worried about stock market going down, the possible solution could be don't invest in stock market, so you're not exposed to stock market downturns. So some risks are avoidable, but some risks are not, like living, like life risk. It's not avoidable, like something can happen anytime to you. So in that case, the outcome is like has some risk associated with it. Avoidance may mean avoidance of opportunity though. Like example, if you do not invest in stock market, you are protected from downside risk, but you give up on the upside potential. You give up on achieving, let's say, financial independence by investing in stock market for a long period of time. Also, it is important to consider impact of exposure. So how much exposure you have, right, depends on how what is the impact of that impact in dollar terms. So let's say you have $100 invested in the stock market and you have an overall portfolio of, let's say, $100,000, then the impact of stock market going down is very low for you. But someone who has 100% of their investable capital in stock market, the impact of stock market going down will be way higher for that person. So how do we measure risk? So probability is a measure of risk, right? So what is probability? Probability is the measure of likelihood or relative frequency that the risky event will occur. Example, there could be a 30% chance of rain in any given day. So it quantifies risk, but it is not risk itself. So probability means if you have a bad outcome, stock market going negative in the next year, so you can assign probabilities to it. Probability is like what is the likelihood of that event occurring, likelihood that the stock market will go down next year. So that is measured by probabilities. Okay, so they have given an example. So this is how a probability chart looks like. The brown one is a normal curve. So normal curve distributed around mean. It means most of the outcomes are towards the mean. That is, they don't deviate much. The green one is more spread out, right? Probabilities. The orange one is even more spread out. So it has fat tails. Okay. So when we study statistics, this is a normal curve. How do you identify a normal curve? Let's say the mean is 12% for all three charts or all three graphs. But in a normal curve, the probability of an event near the mean is way higher. So if you see the probability chart, so 60% returns will be 11%, 60% returns will be 13%. So the probability is way closer to the mean. Okay, if that occurs, it's a normal curve. Then if it is skewed, that is, it has fat tails, right, then there is the statistical definition for that is kurtosis. Kurtosis means that the observations are more spread out, they are not centered around mean. So when you are analyzing risk, when you're looking at risk analysis, you need to make a chart like this. What is the probability of that event occurring? What is the impact on your firm because of that event? For example, let's say your exchange rate movements. There are two firms that are exposed to exchange rate movement. So one is a Canadian firm who has 99% of its sales in Canadian dollars in Canada, domestic, and 1% sale is done to United States. There is another firm who has 30% of its revenues, sales from United States, 70% from Canada. Now, exchange rate keeps on moving, and if Canadian dollar loses value, right, or like the American dollar loses value, then these firms are going to be impacted. So in that case, the occurrence of that happening right now is very high because Canadian dollar is losing value against US dollar for last like 2 years or so because of the interest rate differential. So likelihood is very high. What is the impact though? For firm A, the impact is very low because only 1% of their sales or revenue is from United States. Everything else is domestic. But for the other firm, the impact is very high because 30% of their revenue comes from United States. So it depends on how the dollar or how the Canadian dollar is doing. So in that case, if you're a risk manager, you would try to focus on events that have high occurrence levels, like exchange rate risk, high, like likelihood is very high that it moves against you, and the impact is very high because 30% of your revenue is coming from US. So in that case, if you get your event in probably this square of 4 boxes, then you will try to do something about it. But if your event is somewhere here or somewhere here, right, you might not worry about it because even though the exchange rate might move, and they will move, only 1% of your sales comes from United States. So there is no worry as such. So this risk prioritization is very, very important. Okay. So that's what they are saying. People generally do not worry about this area. They generally worry about like this area for certain. Okay. Now, generally, what is the role of risk management in a firm? So risk management is divided into three kinds of decisions. So there are different finance decisions that a firm does. So there is investment that the firm does. It could be portfolio investment, that is investing in some other company. It could be capital investment, building out factories and stuff, or it could be mergers and acquisition. So this is one department. Okay. The second department is how is this investment being done? Is it done through debt? Is it done through equity? Is it done through raising debt, or is it done through raising equity capital? Then the risk management department measures risk in all these things like investing decisions, financing decisions. So they do measure what kind of risk you face. And once they measure that, then they manage it. So there are management tools that try to mitigate this risk. Okay. The next topic is the goal of risk management. The primary goal of risk management in a firm is to add shareholders value. That is, over a long period of time, you should make more free cash flows, right? So that you can increase the shareholders value for your firm, for your shareholders. Under ideal market conditions, the financial decisions do not add value. So there is this Miller approach. So I am not sure about the pronunciation, so take it with a grain of salt. So it is Modigliani Miller approach, which states that financial decisions do not matter, so firm should not focus on them, right? But this has been proven wrong multiple times. The premise of this model is investors who are investing in the firm, they can hedge their investments, right, rather than the firm hedging the exposures. So instead of firms worrying about risk management, it is investors who should worry about risk management. And that's a flawed way because risk management per investor level could be very like expensive. So it's better for like at least firms to approach or have an approach of risk management. Conditions are obviously not ideal, markets are imperfect, that's why risk management is important. Okay. So why risk management? It prevents financial market fluctuations for interfering with your core business. So you will have better corporate investment decisions. You will have increased competitive advantage with stakeholders. Stakeholders in this sense are everyone. So they could be your employees, they could be your customers, or they could be your investors or debt holders. You have better strategic planning. You have less information asymmetry, less information asymmetry. That is, you're planning ahead. Information asymmetry means if you are exposed to, let's say, commodity prices, when you do risk management, you're planning ahead what happens to those commodity prices in future. So you will have more information and less information asymmetry. You will have reduced average tax liabilities, because tax structures in most countries, not in Canada though, are progressive even at corporate levels. So bigger companies are taxed at a higher rate, the bigger revenues are taxed at a higher rate, like the lesser profits or lesser revenues are taxed at a lower rate. So if you can decrease the variability of like revenues, then you can overall reduce the average tax rate. You can also lower the cost of capital, because the people who are lending to you, if you have a risk management vertical, they will be much more at ease, so they will not ask you premium interest rates. Then you could also have a more efficient incentive compensation, right, if you have a risk management thing in place. So this is an example. So what's happening is, this is taxable income and you're not doing any risk management. So let's say you're exposed to exchange rate or you're exposed to interest rates and you're not doing any risk management. So if you don't do any risk management, the incomes will be very like variable. So sometimes it's $600, sometimes it's $1,500, then it goes to $400, then it goes to $1,600. So variability of income is very high. So what will happen? The taxes paid will be higher. Why? Because in this case, the taxes are like progressive. So let's read through the question. Let's understand the concept and then revisit it. So what's happening? So there is a firm. So suppose a firm's income beyond a particular level, let's say $1 million, million in this case is 1,000, is taxed at a higher rate. The table illustrates the tax paid by a firm, assuming 25% tax, right, for income below 1 million and 40% tax for income below above 1 million. So if your income is above 1 million, you will pay 40% tax. If your income is below 1 million, you will pay 25% tax. So the more income you have above $1 million, the more taxes you will pay. So they have calculated taxes. Okay. And in the second case, they were doing risk management. So the incomes were not that variable. The incomes were quite stable. So in this case, they also calculated, right, the taxes paid on income. So you see the variability is less, right? So this, let's say $300 additional income from here, it is more distributed into 1 and 3 years. So variability is less, so taxes paid will be lesser because your income above 1,000 will be lower in percentage. So that's why the taxes are lower. So you don't need to get into details of this example, but you need to understand that if you have more predictable income and if you have a progressive tax structure, your overall tax liability across a bigger time frame will be lower if you have risk management. Okay. Now there are some key issues in risk management. So the first one is, what risks are hedgeable? Hedgeable means what risk can you like do away with? Some like maybe risk transfer using insurance, or maybe like natural hedges. We'll talk all about that. So hedgeable means what risk can you eliminate. So there is business risk versus financial risk. Most of the times financial risk is more hedgeable. Business risk is something that you have to do natural hedges against or sometimes assume it. Should companies and banks hedge? So should companies use selective hedging? So that is also something you have to consider, because hedging has a cost. So if you are over hedged, then the cost of hedging will be very high. It could be an opportunity cost, or it could be like option or insurance payments that you make. Now how much to hedge? 0%, 50%, 100% of the exposure. That is also something important you have to focus on. Does risk reduction create or destroy value? That is also something that you have to focus on. Some like risk reduction create or destroy value means, so sometimes risk is good, right? Risk sometimes is good. Example, let's say you have an exchange rate movement that favors you. You are exporting a lot of goods to United States, so you are earning in US dollars. So in the last 2 years, you are really happy because US dollar has appreciated against Canadian dollars. So in this case, you would not want to reduce your risk because risk is a positive outcome for you right now. So that is creating your shareholders value. Hedging in the current market environment is always something that you have to consider. Okay, there is risk though. So example is like linens and things bought Apollo for 1.6 billion with $1 billion in debt, right, in 2006. Right, in 2008, right, it was filing for bankruptcy because what happened is markets was very highly inflated. So the price that they paid to buy that company, right, with the debt was very high. Right, when the market dropped in the last recession 2007 2008, the price of their acquisition went below their debt levels. So eventually they decided that there is no point on continuing it and they filed for bankruptcy. So external situations are also very important, right, when you're dealing with companies and especially risk management. Other example is in on 2008 January, a Russian upscale supermarket chain AV borrowed US $50 billion from the European Bank. In 2009 February, Russian ruble fell and AV was unable to service its debt because they were earning in rubles and paying debt in US dollars. So in that case, if US dollar appreciates or ruble falls, they will be in big trouble because their revenues will fall in dollar terms, but they have to service the debt, right? Because they have taken a fixed commitment. So in that case, they might for like they filed for bankruptcy. Okay. Next one, financial risk. So financial risk can be categorized by source. It is market risk arising from market prices. Market prices means anything that has to do with the economic variables. It could be commodity prices, interest rates, inflation, like recessions or booms in the economy, etc. So risk that you face as a firm because of market events, economic event, is called as market risk. Counterparty risk is when you are selling product or when you're taking product, you're buying product on debt. So that is you're using credit to do sales or like taking credit from your suppliers. Counterparty risk means you are not able to pay to your suppliers in time or your customers are not able to pay to you in time because they default. So it arises from transactions with others and that is called as the default risk. Then there is liquidity risk. Risk means you cannot unwind things. Let's say you have too much inventory and you're not able to sell it. That's a liquidity event for you. Or you have like stocks that you were planning to sell to raise money, but the market turns and you're not able to sell your stock, right, in the market. That is a liquidity risk. So it arises from lack of market action. So you're not able to unwind your positions. Now these two risks are firm specific risk. So what that means is in these two risks, right, you if you're an investor, you can diversify this risk away. As an investors, you don't have to take this risk. If you buy like enough companies, if you spread your investments in enough companies, then this risk gets eliminated. But market risk does not get eliminated, it stays on book. The focus of this course is market risk. So we like same thing again. So market risk is economic variables, equity risk, equity market going down, interest rate, exchange rate, commodity prices, economy, etc. Counterparty risk, it is customer risk, customers don't pay you. Supplier risk, suppliers ask for payment but you don't have money, or partners, right, they are not able to like put up their fair share. Operational or liquidity risk, there is financing, market liquidity. Financing means debt turns against you, you're not able to raise finance, right, or the cash flows that you have, right, change a lot. Okay, the main goal is to prevent market fluctuations from interfering with the business. Hedging is only possible if you know your exposure. So the first step is to define and measure exposure. Okay, hedging is also only possible if the institution understands how to use the tools of hedging: forward, futures, swaps, and option. So what is hedging? Hedging is doing away with the risk, canceling the risk away. How do you do it? Either you take insurance or you use financial products. Now, the main goal is to prevent market fluctuations from your day-to-day business. That's the goal of hedging. Hedging is only possible if you understand the risk, if you know the risk. If you do not know the risk, you will not be able to hedge it. And hedging is only possible if the institution understands how effective tools are, how we can use forward, future, swaps, and options to hedge. So steps of hedging, right, or steps of risk management, it is identify the risk, measure the risk, manage the risk, and monitor your risk management. So identify, measure, manage, and monitor. Again, you revisit identify. So what is identification of risk? So the goal is to identify significant financial risk exposures and prioritize them in a manner consistent with management's desired risk profile. So interest rate risk, absolute rate risk, convexity, basis, or correlation risk. So this is part of interest rate risk. We'll talk more about it as the course proceeds. Currency risk, the currency moves like translation, transaction, or economic exposure. Like because of currency movements, you could have translational losses, transactional losses, or losses to value of the firm. We'll talk more about this as the course proceeds. Then there is commodity risk like price moves, right, basis, or correlation. Okay, so that was identifying. So the first step that you do is to identify it. The second step that you do is to measure risk. Measurement is first probability. So probability is assigning like how likely it is that the risk might happen. So probability may be a useful measure of risk, but can sometimes be misleading. What is probability? Probability is a measure of relative likelihood of occurrence of an outcome or an event. It is a relative frequency of like the event occurring. It quantifies the likelihood of risk but not the risk itself. So it just measures how likely is the event to occur. Example, so let's say there is a 30% probability of the event occurring. What does that mean? That out of 100 times, right, 30 times that event is going to occur. That is what probability means. So first is you assign probability to it. Then you do regression analysis. We'll talk more as the course proceeds. So regression analysis measures what is the sensitivity for your firm to this risk variable. Then you have also value at risk, VAR. So how much is at risk, right? So value at risk is a measure of risk. We'll talk about it as the course proceeds. VAR is very important. VAR means how much dollar loss will you face if the risk occurs at a certain probability. Example, there is a 5% chance that you will lose not more than, right, $100,000. So that is an example of a VAR, right? So $100,000 you are likely to lose 5% of times. So qualitative measures are also there. So you can have like a risk event qualitatively defined as high, low, or medium in occurrence and in impact. Now, how do you deal with risk? So first of all, you can do nothing, own the risk, take it on your books. Second, you can diversify, invest in certain different things if you're an investor. So let's say you are exposed to oil prices. You can have, like, let's say two types of businesses in your portfolio. One is oil companies like ExxonMobil, who are producers of oil. So if oil prices go up, they are firms that benefit. You can also have airlines in your portfolio. Airlines are users of oil. So if oil prices go up, they face loss, but if oil prices go down, like, they will actually benefit because their margin expands. Okay, that's the way of portfolio diversification. You can also take insurance on the risk. We'll talk about insurance. Insurance in this case means option contracts. You can also do hedging. You can do selective hedging, that is forecast. And if the forecast is against you, then hedge. You can do partial hedging, cover 50%, 60% of your exposure, or you can do full hedging. Okay. So next topic is risk and financial markets. So one of the best ways to deal with risk is to share it. That is, take an insurance on that. A major role of financial market is to facilitate efficient risk sharing. So risk gets priced and there is financial innovation. Okay. There is the concept of arbitrage too. So arbitrage is, there is inefficiency in the market. So people benefit from those inefficiencies by buying in one market and selling in the other. This happens when two identical assets sell for different prices, which leads to law of one price. Now, how do people deal with risk? Now, you can be a risk averse individual. Risk averse people generally do not take on risk. So I consult with a lot of clients in terms of investments. Some of them are very risk averse. So they will not touch equity markets with a 2-foot pole. So in that case, that's a case of avoiding a risk altogether because you are not comfortable with it. So you can view good results as arising from skill and bad results as arising from bad luck. So that's like something like, it's a behavioral bias that people have. Good things are my responsibility, bad things is just the economy. Think the risk is greater when there is, like, this is very true about politicians, both sides. If the economy is good, they will take all the credit, but if the economy is bad, it's because of, like, let's say global factors, global inflation, war in Russia, that's causing the economic pain, right? So it's a little bit funny. Then think the risk is greater when there is less information about probabilities. So sometimes if you do not have enough information about the likelihood of occurring, you think there is too much risk. You feel differently about risk depending on the age. The younger you are, more comfortable you are with risk. Less responsibility you have, more comfortable. More experience you have, you get more comfortable. Higher wealth, it's a misnomer though. People who are very wealthy are very risk averse because it depends on how you have achieved wealth, right? Gender wise too, it has studies have shown that men are more irrational, so they are more like risk seeking rather than women. It may be thus be prudent to take the human element out of risk management and just rely on statistics. So we are going to talk about a lot about derivatives, right, in this course, because a derivative is a tool of managing risk. So what is a derivative? Derivative is a financial instrument whose payoff is based on some underlying, right, source of risk called the underlying security. Use of derivatives and increase rapidly. Right now the derivative market, like, globally is about like 2 times of the global economy, that is around $150 trillion. Most widely used derivatives are option, futures and swaps. We are going to spend lots of times on all three. Then forward contracts. What are forward contracts? They are an over the counter contract in which one party agrees to buy the underlying and the other party agrees to sell the underlying at a fixed price at a future date. Again, we are going to talk about this in detail, so I'm just going to introduce it. Forward contract is simply fixing the price for a future date. A firm commitment, whereas an option is the right. Forwards are fixing the price no matter what happens. Options are insurance on prices. It this is a subject Is it subject to default? Yes, forward contracts can default. So forward contracts, let's say you fix the price. If price goes above, you benefit because you benefit from a fixed price. If price goes below, you make loss because otherwise without this contract you would have been better. So person who is buying a forward contract benefits when the price rises. Person who sells the forward contract benefits when the price falls. We'll talk more about it in forwards and futures. Futures, same thing as forwards, but it is a standardized exchange traded contract that does essentially the same thing. It guarantees against default. So graph would be exactly the same as the forward contract. Options, imagine insurance. So you can take insurance on price using call options or put options. So call option gives you option to buy at a fixed price. Put option gives you option to sell at a fixed price. Okay. So key terms you need to be worried about is premium, exercise price, expiration, American or European. We have a chapter on options and we are going to cover options more in details during that time. So options are standardized, exchange traded or customized. Most common are customized OTC because like a lot of firms need specialized option exposures. So in that case, they go for customized OTC options. But in terms of stocks, the most ones traded are standardized ones. The loss limited to the premium. So it's like an insurance payment. The only loss you face is the insurance payment if you're a buyer. There is no upper limits on call. You can benefit a lot. So they have given payoffs from call and put. So if the price goes up, you benefit if you have a call option. If price goes down, you do make a loss, but that loss is limited to the premium you're paying. If you have a put contract, if the price goes down, you make money. If the price goes up, you do make a loss, but the loss is limited to the price that you have paid for contract, that is the insurance. Then there are also swaps. So swap is a contract in which two parties agrees to pay each other a series of cash flow with at least one series of cash flow determined by the course of underlying source of risk. So swaps is nothing but a multi-duration forward contract. So when we discuss swaps, we'll talk about it. A profit graph can be drawn only for a single cash flow and it would look essentially the same as the forward contract. Now there are other instruments that are there, like there is insurance available. There are credit derivatives like credit default swaps. We'll talk about those too. There are asset-backed securities and there are hybrids, mix and match of many things. Now risk management. Risk management is as old as commerce itself. It did not really become scientific until the 19th century when the mathematics of risk, probability and statistics were developed. The origin of derivative trading dates back to the 1800s. It did not really take off until 1970s when models of pricing and usage, like that is the binomial model or Black-Scholes model, was actually developed. There are a lot of exchanges that trade derivatives. So there is Chicago Mercantile Exchange and Chicago Board of Options, which are the important ones, the biggest ones. In Canada, we have Montreal Exchange for financial derivatives and Commodity Exchange for commodities. So example, Winnipeg Commodity Exchange has insurance, credit derivative, asset-backed securities and hybrids that it trades. Okay. Important things, some of the largest trading losses in derivatives have occurred because individuals who had mandate to be hedgers or arbitrageurs, they started speculating on it. So the famous example would be the Japanese crisis in the 1990s when the Japanese market started to crash. There was a trader out of Australia who actually brought down a bank because he betted that the price should go up, so he was speculating rather than hedging, and it actually brought almost a bank into bankruptcy. So if such things happen, like, you could have big losses. So that's it for chapter 1. We'll dig deep into these topics. So this was just an introduction part, and from here we'll proceed with more detailed discussions.